Are bankruptcy rules horrifically unfair? Well, I think one of them is, and Ted and I are going to discuss it starting right now.
This is Debt Free in 30. Here's your host, Doug Hoyes.
Ted, welcome back. As you know, when you go bankrupt, you have to make a payment based on your income. You're familiar with this, right?
Yep.
This is not new to you. It's called surplus income. So question number one, does that concept even make sense?
Yeah, at a basic level, it does. It says that the more you make, the more you pay. And the assumption is if you're making more, you can afford to pay more.
So we agree with the basic assumption, the basic concept. So let's talk about the details now.
That's all. Devil's in the details.
The devil is in the details. So as you know, there is something called Directive 11R2, which gets updated every year. So we are going to refer to the 2022 version.
Right.
And it comes out, in March of each year, which is why we're talking about it now. So let's start with a very simple example. Give me a single guy. How does surplus income work for a single guy?
Okay. So the government has set these standards. For a single guy this year, it's $2,355. So let's make our example really easy. Let's say your take-home pay is $3,355.
Beautiful.
Subtract the threshold. Difference is $1,000.
$1,000, yep.
Divide by 2. So your payment in a bankruptcy in this example would be $500 a month. If it was your first bankruptcy, it'd run for 21 months.
So you have to pay, the government sets a limit. However much you're over that limit, you pay half.
That's right.
That kind of makes sense.
Sounds simple.
So what we're going to do is we'll put up on the screen a graphic that shows you what the limits are because...
You gotta give them the whole table?
Yeah, I give them the whole table because it's different based on family size. So
Right.
if it's one person, you're right, the limit's $2,355. So we're not going to go into a huge amount of math here because we have on our website the surplus income calculator. You can go to hoyes.com, type in surplus calculator. You can type in the numbers. It'll show you exactly what it would be. But let's do one more example now.
Okay.
Let's do a family. Let's say there's me, my wife, 2 kids.
Okay, family of 4.
Family of 4. And let's just to make the math really simple, let's assume that I bring in about $2,700 a month. My wife brings in about $2,700 a month.
Okay.
And let's assume I'm going bankrupt, she isn't.
Okay. So the government standard for a family of 4 is $4,375. I'm going to make our life easy for the math again today. We're going to call it $4,400, right? And don't get hung up on that, folks. I'm trying to explain to you how the math works. I'm not trying to actually do the calculation. So you said each of the 2 spouses is making $2,700 a month. So that's $5,400 a month. $5,400 minus $4,400, $1,000. If both the spouses were filing bankruptcy, the payment then would be half of that $1,000 or $500. Because only one spouse is paying, you only pay the penalty based on their share of the income. Now, in this example, they're both making the same amount, so each of their shares is 50%. So if the penalty for both of them going would have been $500 a month, for one of them going, it's going to be half of that, $250 a month.
And there you go. And that is as complicated as we're going to get on the math today as my pen explodes here.
Yeah, you don't want to touch on stuff like child bonus and any of that sort of stuff?
Well, other than to say that the rules are a bit more complicated because there are certain segments of income that are not included when that calculation is done, such as the child tax, Canada Child Benefit, the CCB, which used to be called baby bonus, which used to be called the child tax credit.
Right.
So the government has decided that when you do the math, that particular source of income is not included in the calculation. There are also items that get deducted from your income. So everything is based on net income. How much is on your paycheck? So what would be deducted from your income other than CPP, EI, income taxes, which are obviously deducted from your gross income?
So you're talking about, so I've got my net pay, and what would we allow as a deduction from surplus? Well, the obvious one is some kind of support payment. So if you've got to pay support, then that comes off of your income because it's an obligation that you have to pay. Now, what's another good example?
Well, medical expenses would be another one.
Or a condition of employment. So this doesn't mean if it costs you money to go to work. It means if you need to use your car for work as a kind of example.
Yeah, and you don't get a deduction for it. So, but you're right. The 2 most common ones would be support payments that I am making that reduces my income, and medical expenses that I have to incur that are not covered by work.
And add daycare because it's pretty common too.
Yeah, that would be
another type of one.
Yeah, kind of related to the whole concept of support. So we understand the main concept. You already said it. The more you make, the more you got to pay. Everyone kind of agrees with that. If a doctor goes bankrupt because of all his bad real estate deals, he should have to pay more than a laborer.
And the doctor's a great example. When these rules came about, it was because you had doctors not filing their taxes for 3 or 4 years, owing the government, $500,000 or more, filing bankruptcy and being done in 9 months. The government realized, well, that was a little stupid. So they put these rules in place so that high income earners would have to pay more for a bankruptcy. Like anything else the government ever does, it always affects the guys in the middle at the bottom more than it affects the guys at the top.
So let's talk about that then. There are 4 things that I, don't like about how this rule works.
Just 4?
Just 4. It's only a half-hour show. So I'm going to put this chart back up on the screen here.
Okay.
So this is the size of the family and how much you are allowed to make.
Right.
So if you're a single person, you're allowed to make $2,355. Whatever you make over that, you have to pay a penalty of half. And just to be clear here, we are talking about the numbers as they exist in the year 2022. So if you're watching or listening to this 5 years in the future, then the numbers will no doubt have been different.
Get the new chart.
Get the new chart. Go to hoys.com, type in surplus income, you can see it. What strikes me is I actually went and did some math and said, okay, so if I go from having 1 person in my family to 2, the limit goes up by $576. And then if I go from 2 to 3, it goes up by $673, but 3 to 4, and so on. The numbers do not go up by a consistent amount.
Right.
What's the deal on that? Explain the thought process.
So, somebody somewhere had to guess that, okay, well, so it doesn't quite double when you get a second person in your household. In fact, it only goes up by, 25% or
right.
so? And then when you add a third person, it's more than adding a second person.
Yes.
Which is kind of confusing to me. And then when you add a fourth person, it's significantly more than adding a second or a third person.
Yeah, I don't understand it. And I understand conceptually because they always say, well, 2 can live as cheaply as 1.
Right.
Which isn't true, but it's sort of true because you only, if we're living in a 1-bedroom apartment, well, I guess 2 of us can live in a 1-bedroom apartment.
They've never met my wife.
There you go. But your hydro bill, your phone bill, your cable bill is the same whether there's 1 person or 3. Your internet bill, maybe not if you've got many cell phones, but your cable bill would be a simple example.
Your rent doesn't change.
Rent doesn't change that much until you have to get a bigger place. So you're right. Why is it that when I go from 2 people to 3, the limit goes up by $673. From 3 to 4, it goes up by $771. But from 4 to 5, it only goes up by $587.
Right.
I don't understand that.
Yep.
So again, somebody must have done the detailed math and figured this out, but that seems bizarre to me.
The important thing, folks, is that we don't create these numbers; they're imposed by the government. So
right, that's a very important point because our clients get mad at us and say, "Well, why do I have to pay that?" Well, because that's what the rules are.
Right. We didn't write the law. We have commented on it, God knows how many times, but we're not responsible for setting the numbers.
And we'll give some thoughts on that towards the end. Okay, so my first problem is I don't understand how the numbers increase by the size of the family. Second issue, and I guess a bigger one, is the inflation adjustment. So I went back in time and looked at every year when the government raised the limits. So in 2020, they increased the thresholds by 1.8%. So this was right at the start of the pandemic. I then went to the website the government website that shows what the inflation rate is. I took a look at the annual inflation rate in February of that year because that's when they're coming up with the new numbers. So in 2020, they raised the thresholds by 1.8%. The inflation rate was 2.2%.
Right.
Last year, 2021, they only raised them by 0.2%, basically nothing.
Right.
That's when we were kind of in the middle of the first year of the pandemic. Everything was dead. Everything had stopped. Right. The inflation rate at that point was 1.1%.
Right. So we still had inflation, even though gas prices were down and everything else, right?
Right. Now this year, 2022, they've raised the limits roughly 4.7%, but the inflation rate is higher than that.
Right.
And so it's at least 5.7%, depending on what number you look at. Yeah. And so does that seem right to you that these are not?
What this math means is that every year they're eroding away some of the, the increase that people are experiencing. So bankruptcy is costing you a little bit more every year because they're giving you less of all your other expenses have gone up faster.
And certainly everybody has their own personal inflation rate. You and I have talked about this many times.
Right.
If you have a long drive to work, you're spending more on gas, and gas is up a significant amount.
Right.
The groceries, we've talked about this before too.
Yep.
Also, if you like to eat,
and most of us have gotten used to doing that.
Most of us do. And if you are in the lower income brackets, a greater percentage of your income is spent on food.
Right.
If you're a billionaire, well, very little of it is spent on food.
Think back to our Joe Debtor study where we demonstrated that after all, everyone's expenses every month, they get about $200 left for debt. But just the increases in gas and food in the last 3 months have eaten that $200 up.
Yeah, quite easily. So, I mean, I went on some website, I don't know if it's accurate or not, but gas, when you compare February of 2022 to February 2021, 32% higher. And it's
that was before the war. So that's possible.
Probably even more than that now.
Yep.
Beef is up 17%, chicken up 10%, shelter up 6.6%. So not keeping pace with inflation is my second problem.
Well, and what's curious about that, it would be such an easy thing to implement. That just every year the schedule is automatically increased by the inflation rate.
Well, and I assume that's sort of what they're doing, but
except for your math shows that they're doing less.
Not. Right. So maybe they're taking a look at the inflation rate last year or not as current, or I don't know exactly what they're doing. So that's my second problem. Now, my third problem is geography.
Sure.
The Bankruptcy and Insolvency Act is federal legislation. It applies everywhere in Canada.
It's a universal benefit across the country.
There you go. So the problem is the threshold for whatever the size of your family is the same whether you live in downtown Toronto or Northern Ontario or Calgary or wherever.
Yeah. So use the single person that's allowed $2,355 before they start paying penalties. I don't know what the average rent in Toronto is, but I'd be willing to bet it's close to $2,000 a month.
Well, I looked it up, and based on this website I went to,
was I close?
$1,900 a month. So you were pretty close, bang on, and that becomes, I guess, my fourth issue with this. So let's take that same guy, that single guy.
Yep.
He makes he's allowed to make $23.55 a month. Now, you referenced our Joe Debtor study.
Yep.
We actually have numbers.
Right.
Our average client has net income of $2,646 a month.
Okay.
I realize average, that's for a single person. That's not the family income.
Right.
But more than half of our debtors are single people.
Yep.
So it's actually a pretty good example. So let's take that average person. They bring in $2,646 a month. Mm-hmm. They live in Toronto in a one-bedroom apartment paying $1,900 a month.
Leaves them $756 to eat.
But they have to pay $146 in surplus income because $2,646 minus $2,355, almost $300 over the limit, divide by 2, you're getting almost $150. So you're right. I got $2,646 coming in. I pay $146 in my bankruptcy. I pay $1,900 for rent. I got $600 to live on.
Right.
Food, transportation, everything. Yep. Is that reasonable?
Good luck.
Yeah, it's pretty much impossible. So that to me is probably the greatest problem. And you and I have this discussion with people all the time.
Correct.
They come in and they got a lot of debt. They need to file bankruptcy. And they say, well, you're going to have to give me X number of dollars a month. And they go, well, I don't have that money.
Right.
So what are the implications then of this particular policy? What happens in real life?
So the first consideration everybody has to make is, well, does bankruptcy make sense for me then? If I'm going bankrupt because I can't pay my bills, I can't pay for the bankruptcy, well then how the hell do I get out of this? And so the logical alternative is a consumer proposal.
And so explain the thought process on that then.
So a bankruptcy, you've got to pay what the law says you've got to pay. That's just how it works. It's black and white. A proposal, you're making an offer to repay part of your debt. So one of the conditions usually is you've got to pay more than you pay in a bankruptcy, but the bankruptcy is supposed to be over in 21 months. The proposal can stretch to 60 months. And so if I'm supposed to pay, $250 a month in a bankruptcy, I'm going to pay $5,000 or $6,000 for it. That payment becomes $100 a month if you stretch it over 5 years. So $250 versus $100, the math is pretty simple.
And so is that something you see all the time?
It is. It's becoming more and more common, particularly with folks that are earning, well, even that $1,000 a month example that we started at the beginning where the guy was supposed to pay $500 a month as a bankruptcy payment. He can't make a $500 payment because it just isn't available for them to live. All right, well, so $500 for 21 months, $10,500. Probably you end up paying $200 a month for 5 years into a proposal. So $200 versus $500, that's a pretty easy decision. What it also means, though, is they end up paying back more of the debt. So the bankruptcy gets you out of debt quicker for less money, but it's not manageable. So is it even a realistic option?
Yeah, and so everyone's clear on the math we're doing here. If you have no surplus income, if your income is below the limit,
right,
it's a first-time bankruptcy, you're eligible to be automatically discharged in 9 months.
And you probably pay $1,800.
Yeah, typically it's a couple $100 a month for 9 months. Might be a little bit more, might be a little less.
Yep.
If you're over the limit, then you are automatically bankrupt for an extra year.
Yeah, you're paying for 21 months. If you've been bankrupt before, you're paying for 36 months.
Yeah, because in a second bankruptcy, you start at 2 years.
Right.
And then an extra year again gets added. So you're right. We do the math. It's a first bankruptcy. You're going to have to pay $500 a month. That's $10,500. So let's offer a proposal of $12,000. So instead of $500 for 21 months, it's $200 a month for 5 years. $200 a month. Okay, I got a shot at being able to afford that.
I can probably find a way to do that.
Whereas
maybe
$500 a month, even though it's for a shorter period, I just can't do it. My cash flow does not allow it. So as a result, we end up seeing a lot of people who perhaps in the past, in fact, almost for sure in the past, would have done a bankruptcy and would have been done in 21 months. They're now doing a proposal which is going to last for up to 5 years.
That's right.
Is that good?
Well, it's good in that they're remediating their debts. It's bad. It takes them 5 years to resolve their situation. Now, most people pay them off in about 3.5 years. But they're allowed to take the full 5 if they want to. That means they're carrying this bad credit history with them for 5 years.
And so credit history is an important issue for everybody.
Yep.
A proposal is automatically purged from your credit report 6 years after it starts.
That's right.
A bankruptcy is purged 6 years or 7 years, depending on the credit bureau, after it ends.
Right.
So if you're in a 21-month bankruptcy, you're looking at 8 years.
Maybe 9. Yep.
Could be longer. Yeah, if it's a second bankruptcy, certainly longer. Mm-hmm. Whereas the proposal will purge in 6 years.
Right.
So from that point of view, it's a little bit better.
Yep.
And if you pay the proposal off earlier, then it can purge earlier than that. Now, you're right. Most people don't go the full 5 years.
Right.
And that's primarily because we set you up to be paying weekly or biweekly.
Yep.
So instead of $200 a month, you pay $100 every 2 weeks. You're going to be done 5 months early.
Automatically, just by doing it biweekly.
Without ever making an extra payment. And we've got lots of clients who, hey, I got a bit of a tax refund this year. Here, I'm going to throw it at my proposal. I worked a little bit of overtime. My income went up, whatever. So we're big fans of proposals, but we are also big fans of debtors having choice.
Right.
And really right now, they don't have that much choice.
It's certainly limited.
Well, and in fact, let's do some more numbers.
Okay.
In January of 2022, 79% of filings in Ontario were consumer proposals. Right. So 80% proposals, 20% bankruptcies. If you go back to January of 2016, which wasn't that long ago, it was a 60-40 split. 60% bankruptcies, 60% proposals, 40% bankruptcies.
Go back another 5 years and what you just said was true. Only it was 80% bankruptcies, 20% proposals.
Yeah, when we started this business, we were 10 years old at the time in 1999, 20 some years ago, it was like, 10 or 20% proposals, 80%.
We were the only people doing proposals in those days. There were 6 bankruptcies for every proposal. Now, we were doing 3 proposals for every 2 bankruptcies, but that's because
Well, we've always preferred proposals. Yeah, because people don't want to go bankrupt. People want to say that, hey, look, I tried, I've made some kind of payments.
And the payment's always been more manageable.
Yeah, because it's stretched out over a longer period of time.
This is all about cash flow.
Yeah, there's no interest in a proposal. So whether it's 3 years or 5 years, you're paying the same amount. So we've always skewed towards proposals, but now everybody else also has to because you just can't do a bankruptcy.
Right.
That's the problem. Okay, so we've gone through what the problems are.
Yep.
Can you think of any solutions to this?
Well, what could you do? Certainly they could use different thresholds at different parts of the country. So the threshold for somebody living in a major metropolitan area would be one thing. Somebody living in a rural area or, in a less expensive part of the country, it could be different. That starts to get complicated, though.
Yeah, because how do you draw the lines?
Right.
So right now it's the same for the entire country. So could we go to We'll do it by province. Well, that doesn't make any sense. I mean, Ontario there's a big difference between Toronto and Rainy River.
Right.
So you can't do it by province. Okay, you could do it by district, like court district. So you've got Toronto, Hamilton, London, Windsor, Ottawa, the North, whatever. But even then, there's a huge difference between, Mississauga on the border of Toronto and Mississauga up farther out.
And it starts to get too complicated for the government because it's supposed to be a universal standard for anyone anywhere in the country. So I understand why they do it the way they're doing it. It isn't particularly fair.
Yeah, you could even, I guess, go all the way to the postal code level.
Yep.
But then someone comes in to see you and you go, oh, well, if you live here, it's going to cost you this much. But if you go move in with your mother, who's, 4 streets over in a different postal code,
right, then
the thing will be different. Okay, well, you're right. It just gets to the point where it's unnecessarily complex. So, okay, that sounds good in theory, but in real life wouldn't work. Another possibility, I guess, would be to change the thresholds more frequently than once a year.
Yeah, I mean, it's all done by computers now, so they could adjust it for inflation, quarterly if they wanted to.
Now, that certainly adds more complexity to our world because when someone comes in to see you, you're telling them one thing, but then the math will be slightly different. But presumably, if we are in a period where inflation is going up, then
like now,
even though I predicted that it would be low by the end of the year, so we're going to have a very interesting year-end podcast this year if I'm spectacularly wrong once again.
Right.
But in a period of rising inflation, I guess the debtor isn't going to be too worried about it because it's actually helping them. But what happens if, things turn around and we go back to, slower inflation or deflation? Oh, I said you got to earn this much, but now you only get to earn that much. So that becomes pretty difficult as well. Does the whole grid need to be adjusted? Because we already said that somebody in Toronto, they can't afford to go bankrupt.
Well, so we're making an assumption that whenever they set this grid and everybody looks at it annually for some sort of adjustment, every once in a while you should always go back to zero, right? And create the thing from scratch. We don't know if they're doing that or not. I would guess that they're not because of the way it's been adjusted for the last decade.
And if they did that, so if they said, you know what, the base limit for a single person should be $3,000 instead of $2,300 or $2,400, does that then mean a ton of people now switch to going bankrupt again?
Probably. So if you suddenly had a bunch of people that could do a bankruptcy in 9 months for $200 a month versus paying back, a quarter or a third of their debt, a lot of people would check that option.
And is that good or bad?
Well, so it's good for the people. Well, I guess it's bad for the system in that we're not recovering as much money for the creditors. But the whole idea behind the Bankruptcy and Insolvency Act is to give people a fresh start. It's cooked into the mix that, 1 out of every 100 customers isn't going to pay. That's just the way the smart guys, the actuaries, have figured out how to grant credit policy. If you've got 2 customers not paying, your policies are too loose, you're losing money. If you have less than 1 person per 100 not paying, then your credit policies are too tight. You need to loosen them up. So the question is that 1 person out of 100 that's not going to pay, it's already built into the cost that the other 99 are paying. So I don't do companies. I think companies only want bankruptcy law to be there so that they've got some sort of threat. There's some kind of pressure release valve. They've already worked in the cost. I don't know that they care.
Yeah, and we already know that here in early 2022, spring of 2022, the personal insolvency rate in Canada is at multi-decade lows.
Right, but that's for different reasons.
Right, many different things happening, the pandemic and so on. But we are back. I mean, in January of 2022, the number of personal insolvencies filed in Ontario was about the same as in January 1991.
Yeah.
Like, that's just mind-blowing.
Right.
So if you start changing these rules, does that, also alter everything? If bankruptcy becomes easier, does that make credit granting more difficult? I don't know. Who knows?
Well, I mean, there has to be some sort of viable threat for not paying. There has to be a consequence. And if the only consequence is, well, you'll never get credit again, you don't really have a proper pressure release valve so that the system doesn't blow itself up. So there's got to be a way for people to say, I've screwed up. Okay, I'm going to avail myself of the law to get out of this trouble. But it can't be so easy that everybody does it. Then the cost of borrowing will shoot through the roof.
So I guess what we're saying is we've identified 4 different problems and we have no solutions.
That's
pretty
sure.
much what we're saying. Like it's okay. Probably
there's no easy fix, because if there was an easy fix, presumably the government
would have thought of it.
Right.
So okay, maybe the limits need to be adjusted somewhat. Maybe they need to be a little more cognizant of what how inflation is now ramping up. But it's not a simple fix. So nothing we can tell the government, apparently. Right. Let's finish the show by talking directly to the person who's watching this who has debt, or my friend has debt, they got to do something.
Right.
What is the practical advice we give to someone?
So you've already considered whether or not a consumer proposal makes more sense in the bankruptcy. And let's assume that for whatever reason, the bankruptcy is the route that you're going to go. And there are still a significant portion of people that are doing that, right? So you're going to file bankruptcy, which means that every month you're going to be reporting your income to your trustees. So you've got to control your income. So there's a disincentive for you to work any overtime, right? You've gone into the bankruptcy. The trustees told you make this much money. This is what you're going to have to pay. So if you make more money, you're going to have to pay more, right? So obviously control the amount of overtime that you get. As it's counterintuitive, you don't even want to get a big increase or a bonus, because that's all income that's going to be subject to these surplus income problems.
And on that point, the people we see coming in to see us have worked a lot of overtime in a lot of cases.
Right.
I met with a guy last week who works in a hospital setting, and he's something to do with maintenance or something in the back, but he's worked, I believe he told me, 21 days in a row. Jeez. Because they're so short-staffed, can't get people, and obviously he's got a lot of debt, so he needs the money, so it was to his advantage to pick up all the overtime he could possibly get. Well, as soon as the bankruptcy starts, totally different story.
Right.
Every dollar you make over the limit, you're giving me 50 cents of it. Mm-hmm. And that's net dollars. So you already gave 25 cents of it to the government.
Right.
Now you're giving me 50 cents. So you're left with, 25 cents. The math doesn't really work, but let's pretend it does.
Well, but so for somebody making, $15 to $20 an hour, that hour of overtime where you're getting paid double, you're actually making half.
Right.
So you're making less than a normal hour.
Yeah. And when you factor in taxes and everything. So do you want to be working overtime for $5 an hour? And if the answer is, well, no, I don't, then okay, in a bankruptcy scenario, it really doesn't make sense. Right. So what we see is people going, well, but I need that money to live. Well, you definitely needed it when you were paying $1,000 a month in minimum payments on your debts.
Right.
If the debts are gone, then potentially you don't need that same amount of money. So typically what'll happen is, I'm going bankrupt, I'm not doing any more overtime. The other thing we see a lot is people timing it throughout the year.
Right.
So if you work in construction, you're really busy in the summer, not so busy in the winter.
December, January, February, maybe even March, you're kind of sitting at home or on EI.
That would be the time to go bankrupt.
Your income is lower.
And in a bankruptcy, just so everyone understands, every month you're sending us proof of what your income is, but the payment is based on the average of all of the months. Yeah. So you can have a couple of high months, a few low months, that can get you under the limit. So, okay, you're not going to work excessive income or excessive overtime. You're going to time it during the year. What else do people do to keep their income lower during a bankruptcy?
Yeah. So maybe you're going to use this as an opportunity to retrain, if that's a factor for you. So, go to school or somehow even reduce your income further, because now you're doing other things, not just working.
Yeah, it's very common. Okay, the reason I'm in trouble is because I lost my job, I got downsized, I want to retrain, so I get my, student loan, whatever, I go back to school. Well, during the period I'm in school full-time, I'm not working full-time, my income's going to low. So that, from a timing point of view, kind of makes sense. The other thing I've seen a lot of, you tell me if you're seeing it too, is parents just saying, you know what, I'm going to stay home with the kids.
Oh yeah, you do the math after the income tax, the daycare, and then the surplus income payment in a bankruptcy. It may not make sense for both spouses to work anymore, simply because that second spouse is bringing in so much less. And on top of that, by not working, you qualify for a larger child tax benefit. So, the math is worth doing.
Yep. And even if it's like, well, okay, I'm going to stay home with the kid for the next year, or I'm going to work part-time, you're going to work part-time, keep the income down, that may actually make sense in a bankruptcy scenario. Yeah. Now, the final point, you already made it earlier, is with respect to expenses.
That's right. So there are certain types of expenses that reduce your income before we calculate what your surplus obligation is. So we already said it was support payments or medical expenses, expenses as a condition of employment. Things like this, you have to pay these things, and so keep track of them. that reduce your income before you pay the penalty in the bankruptcy.
Yeah, and so when you come in to meet with us, we'll explain, okay, well, medical expenses, what does that mean? If I have to buy some Tylenol, is that a medical expense? If I have to go to the dentist or whatever.
The standard is it's got to be deductible for tax purposes.
Right. And so if it's something like, dental surgery that I was going to have to get anyways, well, that would be something you'd probably do during the bankruptcy if you can afford it.
Well, yes. So it becomes a timing issue, right? If your benefits are not fabulous, dental surgery is a great example, or eyeglasses. If you're paid biweekly, twice a year, you get 3 paychecks. Well, in those 3 paycheck months, just about everybody goes over the surplus guideline. But if you have a large deduction, like some sort of expensive dental work or $500 or $600 for glasses, you time it so that your increased income is offset by an increased expense, which is deductible. It's just a little planning.
Right. And it's a cash flow thing because, as we said, it doesn't matter what happens in individual months. It's all on average. But if that's the month I got 3 paychecks, well, this is probably a good month to be buying the glasses.
It's the month you can afford to do it.
And it works out. So really the key point we're making here is you got to sit down with your trustee in advance and go through what the next 9 months, 21 months are going to look like. When do I get annual bonuses? When am I likely to get laid off? Do all the math in advance, and then you can make the informed decision.
You have to understand how this works because, 3 out of 4 people, the bankruptcy runs the exact amount of time that it's supposed to run, either the 9 months or the 21, because everything was pretty clear up front. The 4th person, it's almost always comes down to something to do with surplus income. The way they have to report, they got a bonus, maybe they switched jobs. It doesn't matter. The payments ended up being higher than they planned for. They're warned all along, but it doesn't, if your expenses are X and you haven't got X to pay for the bankruptcy, then something's got to give.
Right. So you got to do that calculation, figure it out. What do we think it's going to be? Try to, and I always ask people, so what's a really big paycheck month?
Right.
If you end up getting lots of overtime, let's make sure we've done the math using whatever we can think of as a worst case scenario so that you're fully performed or fully aware of what could potentially happen. And so what ends up happening in a lot of cases, well, I think I'm going to file a proposal.
Right. And one of the benefits of a proposal is there's none of this income testing. So you're making an offer to your creditors up front. You're going to offer them more money than they get in a bankruptcy. So there is a test in that we calculate what a bankruptcy is going to be worth, or at least what we think it is. And then you offer your creditors the payment plan. And once they agree to it, you don't have to disclose your income anymore. So you could get that second job if you really want to. You could reduce your monthly expenses and roll that extra money into this, or you could use your tax refund, whatever. The proposal is a payment plan that everybody agrees to up front. And after that, it's just a payment plan.
And I think that's a good way to end it. All of the thinking should be done up front.
Yeah, surprises are bad in a bankruptcy.
Surprises are bad. So and that's why we like to spend a bunch of time with you up front,
right,
to think through everything that can possibly go wrong. And this is why I'm not a big fan of the debt consultants. They can't think of all this sort of stuff.
They're not interested in thinking all that stuff.
So we go through all the problems that could potentially happen. You know what you're going to get yourself into, and then you can make an informed decision.
Right.
Ted, thank you very much. That is surplus income and, where there are issues with it, but what can be done to solve it. So what I will do is put links in the show notes to our surplus income calculator, how surplus income works, the whole bit, so you can research it there for yourself. Any questions, obviously reach out to us. If you are watching this on YouTube, please like and subscribe. If you're listening on your podcasting app, same deal. Leave a comment, subscribe. We have a new episode every week, including next week. So we will see you then. Until then, thanks for listening. I'm Doug Hoyes for Ted Michalos. That was Debt Free in 30.